Just setting up. Sound is good? I'm doing great. Feeling a lot better, by the way. My cough is almost completely gone, almost completely over whatever I had starting a couple of weeks ago. It is extremely warm here today in the Boston area. It's like 95 or plus degrees. I got to get out there and mow the lawn too, so then walk the dogs. All right, still setting up a little bit here. Interesting. Nobody decided to go over on the Zoom side. I might just do away with that altogether. Let's see here. Yes. Content, live, control room. Just trying to get a gauge for. We don't have a whole lot of people on today. That's surprising. Usually there's like 30 people on. Let's see. Uh, Hold on.
Returning visitor.
All right. I think I'm set to go now. Let's see. Still only 12 people on. What is going on? Where is everybody? They all at the beach or something? All right. So the first thing, we're going to start now. So this is the retrospective for Sunday, May 22nd, where we will look at past week's trades and go over the strategy, what we did right, what we did wrong, and what could we do to improve. We'll also look at any particular issues, take Q&A, all of that stuff. But before I get started, I wanted to say something about the 5 days a week trading. That, when I first started this, yes, I know, Jamie, thank you very much.
Returning visitor.
When I first started, the zero DTE was 3 days a week, Monday, Wednesday, and Friday. And then just recently, they've added Tuesdays and Thursdays on the SPX, and soon it will be full on the E-mini as well, if not already. And that presents, I think, a little bit of a problem. Now, it's a problem because I think that what I found going 3 days a week was like a very nice cadence. And this strategy and everything that I'm teaching, this system is all about growing your account. It's growth, right? We're not trying to produce an income. I don't believe that it's possible to produce an income on any kind of trading strategy because that would imply that the market can actually give you a consistent set of criteria and activity in order for you to generate a consistent income. And that's just not possible. It's totally unrealistic. The other thing is that because we're in growth mode, then I want to be able to concentrate on maximizing the trades that we do and maximizing the effort that we put into each one of those trades. That is not possible, I think, when you go 5 days a week. Now, the final hour trade is a little bit different because it's kind of like in the moment, here and now, boom. You know, it doesn't take a lot of thinking in terms. I mean, it's a compressed amount. It's a compressed version of the strategy, but it's far more reactive and it's hit or miss. We probably shouldn't trade as much on that particular trade. However, I'm finding that our win rate on that is getting much better. So I've got these two different trades to deal with. One where, we're trading Monday, Wednesday, and Friday. I don't want to do Tuesday and Thursday. I like the idea of a day off of reflection. Also, for the purpose of the group, it helps because I can spend those days and concentrate on training topics, coaching, mentoring, and that sort of thing. And that benefits everybody. Plus, I'd like to encourage the whole idea of this taking a day off in between trading and not over trading. I guess that's the real crux, is that I think that over trading, well, I know that over trading is by far one of the greatest deterrents to making consistent profits for people. And not just over trading every day. Some people overtrade each individual session. I don't know why. I know they think it's FOMO, fear of missing out, or maybe their performance wasn't so good and they want to catch up, or they think that they've got an unbelievable opportunity and they just want to keep on pounding it or whatever. Every time that they overtrade, they're going outside of their sort of stated objectives of how they were going to trade. Unless that is your objective. I'm not sure why that would be your objective. I think that just taking one trade, putting the risk in that you want to put in, and live or die by that risk. And then that's it. If you start chasing to try to overcome a loss, then what you're trying to do is what you're basically saying is that you risk too much in the beginning. That's what it's really saying. You risked way too much on that first trade. If you have the need or the visceral need to go and try to make it back because you can't take the loss, then you're overtrading. You're trading too big. That's what it's saying, right? So that's one thing that I want to convey. I think it's really important that whatever trade that you put on, that you're comfortable with it, and you're comfortable with the fact that it might be a loss. Completely comfortable. As a matter of fact, it shouldn't even enter your mind. You just, a loss. We'll wait for the next opportunity. Because again, we're not trying to make profit every time. I mean, what kind of hurry are you in? When you start looking at the big picture, you're trying to achieve some sort of goal over the course of a year in general, right? Every year, that's our big measurement stick, and by which most people judge, whether or not they were a success from one period to a next period, 1 year to the next year. And by all objective means, if you can consistently produce 20 to 30% a year, and you can do that over the course of several years, then you would be considered in the top 0.1% of elite traders. Now, I'm saying that by holding back and being much more conservative, that is achievable in this, to achieve 20 to 30% consistently year in, year out. Now, from day to day, that might not seem like a lot. But over the course of a year, it will seem like a huge amount. And the reason why some people can't really, and some people do a lot better. There's that's the elite of the elite of the elite, right? It's possible with this trading strategy to do 70% a year. It's possible, depending on the size of your account, to triple or quadruple or 5 times the size of your account. Still trading in a modest way, right? So that's what you're going after. You're going after that kind of consistency. You're going after growth with very little volatility in your equity. Some months it may seem like you're going sideways. Other months you make great advances. And very few months you may see a loss. That's the way it goes. I tried to demonstrate this by showing you a Monte Carlo simulation by looking at a fictitious trading account where you're winning at the rate of 55%, and then randomizing your wins and losses and seeing what that looks like. Assuming that you do, say, 25 or so trades a month. And with that randomization, there are sometimes when you ran that over and over and over again, there are sometimes you would have 6 or 7 losses in a row. Can you take 6 or 7 losses in a row and still feel like I'm doing the right thing? Because if you had done that in this randomization thing, there are some times where you have 6 or 7 wins in a row. And over time, or through the simulation, if you had applied that same kind of win rate consistently, you would be a 30, 40% winner at the end of the year. Right? So when you're steeped inside of the trees, you can't see the woods, you can't see the forest. A few losses they mean nothing. It's the long-term game, and it's building up the process. Building your process so that you improve it every time, and so that over the period of 2, 3, 4, 5 months, you start seeing, a 2 to 5, maybe a 10% increase each month. That's what you're going after. You're not trying to hit a home run every trade. Each trade is just another, like the analogy that I use, if you're building a house and you're framing it, you've got a big house and thousands of timbers and tens and hundreds of thousands of nails. Each trade is like a nail. You bang it in, you forget about it, you go to the next one. If you bend the nail, you quickly remove it, put another one in, go to the next one. That's what trades should be like. So now we're adding on to that this additional trade at the end of the day, where I think that you should be taking even less risk, but it may actually improve our overall performance a great deal. I don't know yet. We haven't done enough of these trades. I'm only on, I think, episode 21 of this, so 21 trades that we've done with this. Is not something that you're going to hang your hat on and say, hey, that's what my performance is going to be. You have to do that through many different types of market conditions and then see whether or not what we're doing, and as we evolve, whether it's the right thing. And I think it will be, but it won't be solid until we've put in the work. Put in the work of, say, 3 months of doing that solidly, and then through a number of different market conditions saying, hey, this is what we did, this is what we learned, this is the best way to approach it. We did the same thing for the 0 DTE. It's evolved this entire time since we started back in April. Actually, it really started back in December of 2020. And then it evolved over time. Then I started the business up in April of 2021. And every week we do one of these types of meetings, and we would review what we did, and we would continually evolve the strategy, how we approached it, all the different criteria, where we would place our strikes, etc., how wide we would make it, what in different combinations of market environment, all that stuff went into where we are at right now, and we continue to do that. So we have a lot of good information. And over the course of a year, I discovered that with the strategy that we had developed, we could achieve anywhere from a 60 to a 95% win rate, depending on the market conditions, and average about 150 to 200% return on our capital, which was really remarkable. That is a huge, huge winner. And with that also, we found that about 10 to 15% of our trades, we would actually pin the tail or pin the trade. I like to say pin the tail on the donkey. And that would provide us those little bump up in our equity. It would be like, going around, a little down, a little up, then boom. A little down, a little up, and boom, So that was the cadence that I found in trading 3 days a week, and then as we got better and better. There were some months, we had one losing month, and that was January. I think we had one other month that was just a slight winner, and then all the other months were pretty strong. We had one period of almost, I think, 6 weeks where we hadn't lost a trade at all. And then in January, it was like you couldn't buy a trade. So that's what happens over the long course of trading something like this. And we made mistakes. I made big mistakes. I made one mistake that cut my small reference account in half, which I never should have made. Had I not made that, that account would be way up. So you learn from these things. And that's where that particular mistake is where I decided to completely eliminate broken wing flies, because no matter how you look at it, no matter how long shot the risk side of that trade is, eventually you're going to hit it and it's going to hurt. So I decided to just completely eliminate it. Now, that type of trade, that type of account or capital busting trade no longer exists. So therefore you cannot capital bust your trade. Right? So those are the type of things you learn over time. And I still, to this day, new people come in and ask me about broken wing flies and unbalanced flies and all this other stuff. And I'm saying, nope, we're going to stick super conservative and go symmetrical flies all the way. We put them this far out. We try to go for the nearest long leg, and that's it. We're trying to go for that 150, 200% winner every time, and then sometimes maybe get that 500, 800, 1500% winner. That's what we do. That seems to be the winning formula for this. But it doesn't mean that just because I say it, that doesn't mean that everybody can then immediately then go and do it, because you have to become skilled at the process and not get off the farm, right? And do something stupid, overtrade, trade too big, trade too often, take unreasonable risks, right? Every time you do that, you get off the baseline and you can no longer measure yourself from month to month. I mean, that's really what we're trying to do. We need to establish a baseline, not only in terms of how big we trade versus the account size, but our behavior and how we actually act in there and how well we follow the process. The process is everything. You should be completely obsessed with the process, not with the goals, because the goals will come if you focus on the process. The goals are something way out into the future. You can't see them. You can't see them day to day. And if you focus on them day to day, you're going to make bad decisions. If you focus on the process and on putting on good trades, whether you win or lose, as long as you did that process well, then over time you're going to realize the type of goals that you want. You're going to see account growth over time. If you have a small account in the beginning, I can guarantee you can absolutely count on a lot of account volatility in a small account. That's sheerly a function of the minimum size of a trade versus how big your account is. As you get a bigger account, you don't trade as much. So your account equity, growth equity, has much less volatility in it. And you start making more progress that way. So these are things that we know and that we learned over time. And that's the current state of the technology. And that's why it's so important to focus on the process. Do the same thing over and over. Get extremely skilled at your trading platform. What about debit broken wing butterflies? They don't have the risk that credit. Yeah, they do. They most certainly do have the risk. The risk is further out, and it doesn't matter if it's a credit or debit. On one side of the fly, you're going to have risk. End of story. You also couldn't reach that cough button in time. Now, when you do a credit fly or a debit broken fly, it doesn't matter. You still have risk. If and some of that risk it depend. If you watch the curve, the profit curve, you'll see that in a debit fly, it falls away from you dramatically. Well, actually, in a credit fly, it depends on how you put it. But you still have, in a credit fly, you have the upfront risk. In a debit fly, you have the back end risk. No matter how you look at it, you're taking more risk than you would have if you had a symmetrical fly. That's what it comes down to. So hopefully that makes sense. You know, if you think that you can gain an edge because you think that, now's the time for me to do that, and you go off the farm and do one of these things and you make some money, you're not increasing your trading IQ. You're decreasing it. Because unless you can do that consistently for a long period of time and show that it works, then you don't know. I know because we've tried that. We've gone through that exercise after, 100 and something trades, almost 200 trades. I know that there are, even though the risk is far enough off or doesn't seem like it's that big or that it's such a low probability, I know that there's going to be a certain percent that you're going to hit it no matter what. You're going to hit it, and it's going to hurt. So if you want to try it, then do it consistently over a long period of time and then do it. But I would do it without money. Just follow it and just watch it and then learn from it. Other than that, do what I'm professing, what I'm showing you, what I'm teaching you. It works. I know it works. It produces small risk, huge potential profit. It produces a positive outcome. There's actually math to back this up. I read a whole article, this whole treatise on this that Nassim Taleb did, and he showed the math that an asymmetrical trade where you put on very, very tiny risk with huge potential outcome always has a positive expectancy. As soon as you start increasing your risk, whether it's near or far, that positive expectancy starts going to zero. If your risk is bigger than your potential profit, in other words, you produce a much higher probability trade, then your future expectancy or your profit expectancy in the long run becomes negative. So I don't know why you would do that. I don't know why you would go that direction. It makes more sense to go the other direction, to have the positive expectancy. Forget about earning. Forget about earnings. Forget about trying to time. We're not doing earnings. We're not trading stocks. We're trading one thing. We're trading the market. All right. Let me just put that up there. All right. So you're talking about this kind of edge case that happens every once in a while. You have this one particular stock and you're saying, well, what if I try this? That's great. But can you do that consistently and show me that you're going to have a positive outcome if you do that 5 times a week for the next 2 years? And you put that same trade on, what kind of return are you going to get? There's no way to tell, first of all, because there's not enough occurrences for you to even know. So you're really just guessing at putting this trade on. That's all it is. It's just a big guess. We're not working off of guesses here. We're working off of things that we can control. We're working off of the market. It's very simple. We don't have to worry about, the earnings per share or the products that a company's coming out with or their standing in their particular market sector. We don't have to worry about any of that stuff. We only have to worry about the total market. That's what gives us our edge. That's what allows us to create the baseline from which we can build a strategy. All right, let's see. Are there any more questions on that? So, are you still using SPX ES? Well, we generally trade the SPX because that's another change that has been made. In the beginning, I was a huge proponent of trading the futures. And the reason, well, there's a few reasons. One thing that will never go away is that all of our analysis has to happen with the futures because it has volume. You cannot do the analysis on the SPX. The only reason I wanted to trade the futures was that it gave me the ability to take a trade outside of market hours. I felt that I could get more potential premium in my trade. What I discovered was that wasn't necessarily true. The premium decay between pre-market and right up to about 1 o'clock in the afternoon is negligible. So therefore, trading outside of market hours didn't make a lot of sense. There are two detractors to using the ES. One is that the commissions are much higher. They're about 6 or 7 times higher than the SPX. So for small accounts, it makes it very, very difficult to get ahead. Although last year I proved that I could do it. You can do it if you trade consistently and don't go off the farm. And I was able to take a small account and bring it up big, even with that thing I had to overcome on every trade. I had to overcome 36 to 40 cents of cost just before I started making a profit by using the ES. With the SPX, you only have to overcome about 6 cents. Huge difference. Now, there's another detractor to it, and that is that you have assignment risk. That if you take it right to the end of the day, although I never found this to be like a problem because I would just get out of my ES trade before expiration and I would never get assigned. Or if I did for some reason get assigned, I would be ready to be able to take that off as soon as that assignment came into my account. I had it all set up. But most people don't have that skill or that acumen or the knowledge or the understanding of what they need to do to evacuate that trade. So they suffer if once they're assigned, the trade goes against them. To me, it was just get out before it expires. With the SPX, you don't have to worry about expiration because it's cash settled. So the worst that's going to happen is that you're going to experience your max loss, which should be very, very small. And the broker is going to simply either debit or credit your account, and that's it. No contracts, you don't have to worry about any kind of assignment, everything's clean. Plus, if you let it expire, you don't get tagged with a pattern day trader trade, of which you can only take 3 in a 5-day rolling period. You get 4, and then you're toast. That means they close down your account for 90 days. However, we developed a technique for getting around the pattern day trader rule where we could hedge our SPX trade. So even on a small account, we can trade the SPX, hedge it, and allow both the hedge and the original trade to expire, and thereby locking in our profit or gain or loss or whatever it happens to be without getting tagged on another day trader trade. So these are all things that we've learned over time. So we've learned how to, and now that we know that we don't, it is actually a higher probability for us to take a trade mid to late morning than it is to take it outside the market. Well, that means that, well, we don't have to use the ES, so that problem goes completely away. Now all we have to concentrate on is the SPX, and we just have to make sure that we don't get involved in a pattern day trader rule if we have a smaller account under 25,000 by employing one of these strategies. So now the SPX is like the de facto standard thing that we trade for those reasons. However, we still use the ES to do all of our analysis because it has volume. SPX, and it also trades 24 hours a day, which gives us continuity of the index, allowing us to actually get all the volume that we need to make rational decisions. Web Motors Sales says, some of my issues in the last few weeks were I picked the wrong direction, and when I got the corrected direction, my timing was too late. Look, if you pick the wrong direction, what does that mean? It means that your trade is no longer good, right? It's going to probably experience a max loss. You think. So my advice would be just to let it go. Now, there have been many cases, I'd say probably 30% of the cases, maybe 25, 30%, where we've apparently picked the wrong direction, and then later in the day, it turned out it was the right direction and it ended up being some of our best trades. So just because early on in the session you've determined that you've picked the wrong direction and now you're going to take it off and try to put on another trade, you could end up losing on 2 trades. This is what I'm talking about, over trading and chasing the market. Don't chase it. You do your best job at doing your analysis up front. You take the trade, you live with it. And that's it. End of story. There's nothing else to do. Of course, if it comes, close to your profit zone, then there is obviously something to do. Now you have to manage your profits. We don't manage the risk. That's a principle here. We do not manage the risk. I don't know how else to say that. We do not manage the risk, period. The way we manage it is by putting on small risk. That is our management, period. End of story. That's it. If you choose the wrong direction and it ends up that way, okay, go on to the next trade. Does the bear market mean anything to you, or does it matter? No, it doesn't. Because we're trading in a very small time frame, a little box of time. All we have to do is try to predict where price is going in that little box of time. And on the end of day trade, it's even smaller. We only have to predict where price is going there. So whether it's a bear market or bull market, it really doesn't matter. And we saw this last year because we were in both bear and bull markets, or, huge trend ups, huge trend down. It didn't matter. We were equally as good or bad in both directions. It didn't matter because we were only concentrating on that small bit of time. Would you recommend ES for smaller accounts due to the lower dollar risk per contract? No, because that's bullshit. There is no lower dollar risk per contract. The dollar risk comes in how you set up your butterfly. The risk that you take in that debit plus the commissions, that's your risk. I can put on the same risk on an SPX in terms of that debit as I can with the ES, but the ES will end up costing more because I have to get over the additional 36 cents that I have to get over the commissions. So I don't know what that means. Yes, overall the contract's smaller, but that has no bearing on your total risk. The only thing that has bearing on your total risk is the debit that you take relative to the size of your account. That is the only, and plus the commission. It's the debit plus the commission to the size of your account. That's the only thing that matters. Well, this is a good point. Thanks, Ernie. It's a mindset that I have to work out, do my best in trade. And I'll tell you, that is the one thing that is the biggest challenge for all new people coming into this service. And that is to completely divorce themselves of everything that they've known about trading before, that taking high probability trades is not high probability winning. As a matter of fact, it's exactly the opposite. It is the antithesis of high probability winning. You have a much better probability of winning taking smaller probability trades with much larger risk. Much larger potential profit. But it's counterintuitive, so it's very difficult. Plus, it's not what you've been taught your entire trading career. Yet, the most successful traders in the world, the ones that are not the 95% of losers, but the 5% of winners, that's the way they trade. They take small risk, huge potential profits. The most successful people in the world that make money in business, it's the exact same thing. They take small risks for huge potential profits. It is the number. Very rarely do you hear somebody who puts it all on the line to try to make something big. Those are wonderful stories, but they are not the norm on the people that make it big. The people that make it big make it, and see, here's the thing. The people that make it big, you can bring them all the way to zero and they can do it all over again. The people that made it big by taking huge risks, right? They couldn't do it all over again if you gave them another shot at it. It's a one-shot deal. The people that make it big, that consistently go into new businesses or new ventures and blow them up, do it all the same way. They take small risks, huge potential upside because they have knowledge of what they're putting into. They know that risk has good potential upside. They know that they can afford to, throw this amount of effort into something, and that if it clicks, that it will turn into something big. The other way around, I'll repeat it again, the person who takes the huge risks, right? If they made it, say, 1 out of 10 times, that would be a miracle. You try to give them that same, let's say that you brought them to zero again, you gave them that same thing, they would fail. Give it to them again, they would fail. They would fail over and over and over and over again, and they would be out millions and billions of dollars. The people who make it, the serial entrepreneurs, they put tiny risks, and they can stay in the game for a long, long time until they hit it big. It's the exact same way in trading. Exact same way. All right. Any other questions? So if you're new, what you need to do is you need to go through the course. It's on the website. You have to be logged in. Make sure that you pay attention to the volume profile course. At some point, I'm going to update it. I created that course a little over 3 years ago, and I taught it to a lot of people when Bitcoin was really big and really coming on the scene, and when it made that first run up. So I use Bitcoin as the example in the course, but it doesn't matter if it's Bitcoin or the SPX or oil or gold. It works with every asset. Volume profile is the key to everything that we do. We do not use any kind of technical indicators. We don't use any indicators at all. We don't use trend lines. We don't use moving averages. We don't use RSI, MACD, stochastic, none of those things. We don't use Fibonacci or Elliott wave or any other numerology. We do exactly what the most successful traders in the world do, and that is analyze volume profile and order flow. Now, we don't have the ability or the tools to analyze order flow the way most of these successful traders do because we don't have, those tools are very expensive, hard to understand, and take a long time to recognize the patterns. And so instead, we do what the other tool, the other big tool, the main tool that they primarily use, and that's volume profile. Volume profile has been used right from the beginning. It hasn't always been in the form that you see, but it certainly has been at the forefront of traders right from the very beginning of the stock market. they were always looking at volume at price. That's how they made their buying and selling decisions. Volume at price. They did this in the very beginning in the 1800s by just looking at how high they could stack orders at various prices. They had these pegboards, and the orders would come in on slips, and they would put it there, and they'd say, oh, geez, that price on that asset is like this. Therefore, that's where the activity is. They did this. Then the ticker tape came. It was the same thing. They would use the ticker tape to accumulate volume at price. And it wasn't until really the late 80s that we started getting access to real-time information and started looking at this stuff. And then when people and online brokerages came online in the late 80s, early 90s, of which I was 100% part of putting brokerages online, the very first brokerages, that the whole game changed. Now we had all these people coming into this new market. Now the brokers had to figure out how they're going to make money because they weren't going to be able to charge what they were charging before per trade when they were charging, $10 or $15 for every trade or more. Now they had to bring it to the mass market. They had to figure out a way that they were going to make money off of all these people. So they certainly didn't show them volume profile. What they showed them is how to create transactions, because that's how they make money. I'm not going to go into the broker narrative, but let me just say that the broker's not your friend. They are not trying to give you technologies that help you succeed. The people that work for them that are trading are one of two people. They are the market makers who are performing a pure arbitrage. They make money between the difference between the bid and the ask. It's guaranteed money, right? That's how they make their money. They work for the broker. The other people that work for the broker are options traders who are basically selling options. That's basically what we do. We sell options. We collect premium. Those are the only two people really consistently that are making money. Sure, there's a few other people that are doing price action and this or that or Elliott Wave or whatever, but they are 0.1% of the population. 95% of all traders, retail traders, lose money. And that's a simple fact. There's been many studies. There's a huge Brazilian study that showed with over 350,000 traders, and 95% of retail traders lose money in the first 90 days of their account opening. And then within another 90 days, there's some large percentage that totally wipe out their account. What the brokers know is that those people that wipe out their accounts, they'll come back sooner or later, and they'll start the whole process all over again. And the broker will keep on feeding them all the tools of technical analysis to get them to produce transactions. They'll put their sell-side analyst up there to get you excited about various stocks or plays out there, again, to create transactions. None of it is about helping you make money. It's all about you creating transactions. So what we do is we try to create as few transactions as possible, but as smart as possible, employing the same techniques that their traders are using to make money. It's pretty simple. Can you please make new volume profile class soon, so new members can watch it? Why? What's wrong with the old one? Are you saying that you can't do it because the old one is not good enough? I understand that it could be updated, but the old one is perfectly fine. Besides that, I provide analysis of volume profile now every morning, live. You get a free class every morning. Right? So this is not to pick on you. I'm just saying, don't use that as an excuse as to why you can't get up to speed. Because you have all the tools that you need to get up to speed. You have complete access to me during the day. I am completely available. I am providing information to you every day, live. There's no reason why you cannot pick this up and develop the skills. All right, so Mukesh, you must be new. During the live, can we ask questions we do not understand, plus how to set up the trading view or toss? All right, so is there anybody else out there that's been a member for any period of time that can answer that question? Let me ask you this. Have I ever not answered a question? How about this? Have I ever not answered your phone call? I know that there's probably a delay here, so it might take a little while for that to come through. I'm waiting. Someone answer. Maybe it's all new people here today. So let me just put it this way. Every live presentation that I do is completely interactive. Yeah, see, Les, you always answer. Like today, everything is always live and interactive. I take questions throughout the day. You can ask me a question anytime. You can put it in the Discord. I would prefer that you don't send me email because I would prefer that you put it in the talk channel of the Discord so other people can see it and take advantage of the answer. I would prefer that you don't send me a private message in Discord. Put it on the talk channel so everybody else can see. I can guarantee you that I'm the only person in this industry that puts his telephone number out there and takes and answers the calls of his members. I am the most accessible operator of a service anywhere. Okay. So there's no excuses. The only thing that you need to do is listen to what I'm saying. Develop the process. Become totally obsessed with the process of putting on a trade. Doing the analysis up front, doing your homework, putting on a trade that makes sense, managing the profits. If it goes bad, no big deal, move on to the next one. Develop a non-attachment to the thing that you put on. All you care about is the process that you do. Get better at that process. Get skilled at your platform, your trading platform. Know it inside and out. That's where most people make their mistakes. That's right. Take the training. Do the training. Yeah, well, is Damien. I know Damien's called me several times. I always answer the phone. Now, when you become a full member as opposed to a trial member, I'll even set up time with you and go over and help you develop a plan and provide real coaching sessions for you. Gonna love that cough button. All right. So there you go. Hopefully this is a good introduction to what we do here. If you have any other questions, I'll answer them. I don't like spending too much more time than an hour on these things. Plus, my voice is kind of going. All right, are we good? All right. Cool. I hope everybody has a great rest of the weekend. I have to get out there and mow the lawn in this heat. And then we'll see you tomorrow. I'll start looking at the market this evening, see if there's anything worth commenting on. I'm really happy with the way the Discord is going. Fantastic group. So let's see. Here's a comment. If you're willing to learn, you will learn a system to make you successful. Yeah. You just have to apply yourself. And like I said, be obsessed with the process. Do not be obsessed with goals. Goals mean nothing. Perfecting your process is the most important thing that you can do. All right? So, peace to you all. We're fading to black now.